Hello and welcome to The Banker. I'm Danielle Myles, Investment Banking and Capital Markets Editor, and I'm here today with Mark Yallop, who is Chair of the FICC Markets Standards Board and also an external member of the Prudential Regulation Committee of the Bank of England. Mark, thank you very much for joining me.
Thank you, it's a pleasure.
You head up an organisation which was launched about 2 years ago, the FICC Markets Standards Board, and it was part of the response to the revelations about the manipulation of LIBOR and FX benchmarks. And you serve a very important role. The organisation serves a very important role in the FICC markets. But for those who aren't too familiar, can you just explain a little about its mandate?
Yes, of course. So I think the first thing to say is that good regulation is essential for fair and efficient and effective markets. Mm-hmm. No one would deny that. But after the crisis, people realised that regulation wasn't enough on its own. There are a number of issues with regulation. First of all, regulation tends to be defined within the national boundaries of a particular jurisdiction, whereas wholesale markets are global, and the firms that are in those markets are operating globally, not just in one location. Markets are very innovative. People develop new products, they develop new markets, new ways of trading. And it's tough for regulation to keep up with the speed of that new development in markets. So regulation is not enough to address the conduct problems that were revealed through the crisis. And the decision was taken in 2015 by the authorities here, the Bank of England, the Treasury, and the FCA, that the industry should be tasked with producing a body to create standards for behaviour in wholesale markets, standards that fill in a gap that exists in the regulatory framework. Regulation, as practiced in this country and in many other places in the world, consists generally of a series of high-level principles. Treat your customer fairly, act with integrity, be open and honest with your regulator, statements of that sort, and then a detailed rule book that tells you exactly how to interact with the regulator, what information to supply, and with what regularity, and so forth. But in the gap between those high-level principles and the low-level rule books, there is a tremendous amount of uncertainty and lack of clarity about exactly how business should be conducted. So when, for example, foreign exchange traders who are hedging a portfolio of barrier options, or when the syndicate desk is launching a new bond deal, or when commodity traders are talking about what's going on in the commodity market, in the oil market, or in the gold market, regulation does not give them enough clarity about how those activities, how those conversations, how that behaviour should be conducted. What we are trying to do is create that clarity by detailed, practical standards which really explain to all users of markets, the banks who are making prices, the issuers who are raising capital in markets, the investors who are providing capital, other firms who are providing infrastructure for those markets, exchanges, clearing houses, CCPs, data providers, how, in fact, wholesale markets should operate on a day-to-day basis. It's a huge task, which, as you say, we only started on relatively recently, and there's plenty of work to do, but that's essentially what we are tasked with delivering.
Market misconduct is detrimental to many different players in many ways, but there's also a cost to the banking industry itself, isn't there? Could you tell us a little about that?
The cost to the banking industry of misconduct in wholesale markets has been massive. Actually, the cost of misconduct generally has been massive. In 2015, 50% of the entire net profits of the UK banking industry was paid away in conduct fines. So half of the return on capital that UK banks earned was paid away to the regulators in this country and abroad in those misconduct costs. More generally, over the last 5 years, the total cost of the global banking industry of misconduct has been $375 billion, of which about 80% relates to wholesale market activity. That $375 billion of money paid in fines and restitution, if it had been retained instead as capital by the banking industry, would have supported $5 trillion of lending to the real economy. So that gives you a sense of what the cost is. But I think the cost is really more than just the financial penalties that the industry has paid, and this is really crucial. The true cost, the enduring cost of misconduct for banks and for the financial services industry has been in the loss of trust in banking and in the banking industry that the discovery of these problems has brought about in the minds of the public at large, of the rest of the economy, politicians, journalists, and other commentators on what's going on in the banking industry. And the industry has a really tough challenge to regain that lost trust. This, what I'm engaged on with the FICC Markets Standards Board, is one of a number of important initiatives whose long-term benefit, I think, will really be in rebuilding that sense of trust that has been surrendered.
And I know, obviously, you have recently released a standard on the corporate bond issuance process. Can you tell us what else is in store for the rest of the year? I understand there's a number of other standards underway.
Yes, so we've got a lot of work underway at the moment. We're working on some standards in relation to electronic trading. Electronic markets are increasingly important now for execution of business, and many issues arise in that area. Definition of first line of defence, how suspicious transactions should get reported to regulators in the fixed income world. That's well established for equity markets, but it's much less clear for the fixed income markets. More work on the surveillance of FICC trading businesses. We're going to do some work on loan trading, secondary market loan trading. We're already doing some follow-up work to our new issue standard published last year in relation to risk management transactions and hedging activity that investors and issuers might do around a new issue, which could have the effect of disturbing the underlying reference markets. So we've got 7 or 8 active pieces of work underway right now, which I hope we can get published during the first half of this year. Then we'll review where we want to go in the second half of the year.
Mark, thank you very much for your time.
It's a pleasure. Thank you.